If you're into grid trading, I bet you've hit this exact wall. You've got your capital, you're ready to deploy it, but how? Do you go all in on one big, concentrated grid, or do you slice it up and run a bunch of smaller ones? It feels like a huge decision, right? Well, today, we're going to dig into the math and run the simulations to find out once and for all. All right, let's just get right to it. This is the big question. One massive grid or a whole bunch of little ones? You see this debated all the time, and man, people have strong opinions. But we're not going to rely on opinions today. We're going to let the numbers do the talking. So, to really get to the bottom of this, we're going to set up a little experiment, a clean head-to-head comparison. We'll take two strategies, give them the exact same amount of money, the same price range, and just let them run. Let's see what these two setups actually look like. And here we go. This lays it out perfectly. So on the left, that yellow setup, that's our single position champion. One big bot, 10 grids. And on the right, in blue, that's our multi-position challenger. Same total capital, but we've split it across 3 separate bots that each have 10 grids. They definitely look different, but let's peek under the hood at the actual numbers. Okay, let's break down the numbers because this is where it gets really interesting. Look at this. The total capital, identical, $1 million each. The price range they're covering, same thing, 36%. And this is the most important part, the grid width. The gap between each trade is exactly the same, 3.6%. The only real difference is how the money's spread out. The single position loads up $100,000 on each grid line. The multi-position strategy, it sprinkles about $33,000 on each of its 30 grid lines. So on one hand, we've got fewer, bigger bets, and on the other, way more, but smaller bets. You gotta wonder, does one actually have an edge? Let's follow the money and do the math to see if splitting things up really changes the final score. First things first, we've got to agree on how these things even make money. And it's all about this super simple idea, profit per trade. Every single time the price zips across one of those grid lines, a trade happens, and you bank a little bit of profit. The formula for that profit? It's just the capital you put on that grid line times the width of the grid. That's it. So let's plug that formula in and see what happens. For our single position, yeah, each trade is a pretty nice earner. It's usually a big chunk of capital, a tenth of the total. But look at the multi-position setup. Each individual trade is way smaller, right? Only about a third of the size. Because that same capital is stretched across 30 grids. So it kind of feels like the single grid is the clear winner, right? Bigger profits, case closed. Well, not so fast. And boom, here it is. This is the whole key to the puzzle. What you have to realize is this. For the price to move enough to trigger one of those big trades on the single grid, that same price move actually triggers 3 of the smaller trades on our split grids. And when you add up the profit from those 3 little trades, you guessed it, it's exactly the same as the profit from the one big trade. The magic is in the frequency. The higher frequency of trades perfectly cancels out the smaller profit from each one. Okay, so the math looks solid on paper, but you know what they say. The proof is in the pudding. So we're going to put this to the ultimate test. We ran 1,000 different random market simulations to see who comes out on top. Let's see what the data says. And would you look at that? The results are in. Every bar here just shows how often a certain profit level was reached. Yellow is our single grid. Blue is the multi-grid. I mean, just look at them. They're practically mirror images of each other. The range of outcomes, the probability of hitting them, it's all the same. And if we boil all that data down, I mean, all 1,000 of those simulations, the final verdict is just, well, undeniable. The single grid's average profit was $438,700. And the multi-grid setup? You're seeing that right, exactly the same, $438,700. The math wasn't lying. There is absolutely no profit advantage here. Now, this leads to a question I hear all the time. I know what you're probably thinking. Okay, fine, splitting into identical grids doesn't work. But what if we just pack the grid lines way closer together? More lines means more trades, and more trades has to mean more profit, right? Well, let's check the data on that too. This chart, wow, this is super important. It shows what happens as you cram more and more grid lines in. That blue line, that's your gross profit before fees. And look, as you move to the right and make the grid denser, it actually goes down. Why? Because each trade is now capturing a tiny little price move, so the profit on each trade just shrinks and shrinks. And even worse, look at the red dotted line, your trading costs. They're going up. So your actual take-home profit, that green dashed line, it just takes a nosedive. The big takeaway here, chasing more trades is often a recipe for disaster.
So, if splitting your capital on the same asset in a same range gives you no extra profit, why on earth do so many smart traders do it? Well, it's because they're not doing it for more profit. They're playing a completely different, much smarter, strategic game.
And here's what that game is all about. First up, and this is the big one, risk diversification. Don't put all your eggs in one basket. You split your capital to run grids on totally different assets that don't move together. Second, you can cover a much, much wider price range. You could have one grid for a sideways market and another one ready for a big breakout. And finally, for the really big players, splitting up trades is just about not moving the market against yourself. It's smart execution.
All right, let's tie this all together. After all the math, all the simulations, all the real-world strategy, what's the one thing you really need to walk away with?
It all comes down to this. Let this one really sink in. As long as you're talking about the same asset, the same price range, and the same grid width, splitting your capital into more bots does not magically make you more money. It just doesn't. The math is undeniable. Don't split your capital hoping for a free lunch. Do it with a purpose.
So where does that leave you? The next time you're setting up a trade, the real question isn't just what to trade anymore, is it? It's about how you architect the trade itself. Now that you know the math, you can stop worrying about pointless splits and start thinking about smart structure. So how are you going to build your next position?